Hey, good morning, everybody, and welcome to this latest live show with earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with all of you this morning. I do want to say a couple things before we get going this morning. First of all, I was out of town this past weekend, so unfortunately, I was not able to do a weekend video. So we should be back on this weekend and get things cranking again with that. Also, because of last week being such a big week with earnings and all, excuse me, it was really hard. I did catch up on all the chart lists, so we should have all the chart lists now up to date. But I was unable to get to the weekly market report, which again will be on track again this week. And then also the key manipulation Excel spreadsheet that I like to do for a lot of the individual stocks, just to show you how they're trading on an intraday basis. We weren't able to complete that. Actually, it's been the last couple of weeks, but I am in the process of getting that done. So this week we should be back to date there. So anyhow, just wanted to kind of give everybody an update there. We should be back on track again this week. This is also a big week for us because it is a portfolio draft, what we like to call portfolio draft, where we line our portfolios with 10 equal weighted stocks, and then we hold them for the next 90 days or the next 3 months. We're about to wrap up today in our portfolios, and we've had a pretty good quarter for our portfolios, beating the S&P 500 again, unless something drastic happens today. So that's always a good feeling. I know it's very difficult for a lot of professional portfolio managers to beat the S&P 500 over the course of a year. And we set the bar pretty high, trying to beat it every quarter. And we did a really good job of it this past quarter. But this evening at 5:30 p.m., we will have our next portfolio draft to unveil the 10 stocks that are going to be equal weighted in each of our portfolios for the next 3 months. So it's a big day for us at Earnings Beats. And I certainly hope if you're a member, you can attend or maybe go and watch the video. For me personally, I like to trade stocks, and I spend most of my time, or a lot of my time, trading the individual stocks that are in our portfolios, because I do believe those are some of the best stocks, going forward. And I think they'll present some great opportunities for trades as we move forward. So with that, I know futures this morning, we'll go over all the action from yesterday in just a minute, but futures this morning were a little bit mixed, but mostly flat. I think the Dow Jones was doing the best. The DIA, which tracks the Dow Jones Industrial Average, is up about 0.25% this morning. The Spider, which tracks the S&P 500, down a little bit less than 0.1%. The QQQ, of course, tracking the NASDAQ 100. That's the more growth-oriented index. That is down about 0.2% this morning. And then the small cap IWM is almost flat, down 0.02%. So it does look like we're going to get off to a pretty flat start. Looking ahead, we have the Fed meeting, or not the Fed meeting, but the Jackson Hole Symposium this Friday, and that's where Fed Chief Powell will deliver a speech. That's an annual speech that he makes. And I'm just going to be holding my breath during this speech, because I think the market has definitely taken a turn in the direction of believing that we have interest rate cuts coming. And then, of course, last week, we had the PPI come out, and it was much, much, much hotter than expected, coming in at 0.9%. Nobody saw that one coming. I think the consensus estimate was for a 2% rise, and same for the core PPI. So it wasn't just the headline number, it was at the core level as well. But the key to me is whether or not that gets passed through to the consumer. And so far, we have not seen any of that. So I believe the Fed should be looking at the risks as being higher on the economic side rather than the inflationary side. But who knows? Your guess is as good as mine. Powell's been all over the place in the past. I don't trust him. I don't think the market trusts him. And if he does talk on Friday about the PPI and how hot that was and how they've got to take more time, I don't think that's going to be viewed favorably by the market, not based on the way it's been trading. But we'll see. Again, I don't know what's going to be said on Friday. I just want to throw it out there. I do think that that is something that, we need to be at least thinking about, because it's only 3 days away. And we know what happened back in 2022 when he came out and said more pain ahead after the market had already recovered 700 points. The S&P 500 had recovered 700 points off of the bottom in June, had pulled back just a little bit going into that speech. And once he delivered that speech, the market went back into free fall. So I don't trust him. The market doesn't trust him based on the way it trades. And he's had a history of being late to the party. And we'll see what happens on Friday. But let's go ahead now. Let me get you set up here. Bear with me a second. All right, let's take a look at what happened yesterday. So we had the Dow Jones Industrial Average yesterday dropped 34 points. The S&P was flat, still sitting at 64.49. So when we do go into this meeting on Friday, we're going in basically on all-time highs. I mean, depending on what happens, obviously, over the next couple of days. But right now, we're sitting essentially at all-time highs. And so, again, I don't know what the Fed's going to say, but the market is anticipating reasonably good news from the Fed. That's the way I would categorize it anyway. The NASDAQ gaining 7 points yesterday, NASDAQ 100, which is, more focused on those larger cap names, many of them in technology space. That one was flat. So really not a whole lot of movement yesterday. And you can see the VIX back down below 15. So as the VIX continues over time to move lower and lower, we're seeing less and less volatility, more and more of these days where it just seems like the market's not really doing much, and yet we still keep setting new all-time highs. That's kind of the hallmark of a secular bull market advance. I do think if the Fed cooperates, things could pick back up again. Although, August and September historically tells me that we should be somewhat grounded. We shouldn't set the bar too high. Not that the market doesn't go higher in August and September, because many times it does, but we know historically the tendency is for the market to struggle between now and the end of September. So we've got all that out there. And I think if the Fed were to throw, a fly into the ointment, who knows? Maybe the market, we've got room to the downside, to the moving averages, to recent lows, to the breakouts that we saw back in February. I mean, there's certainly room to the downside for the S&P to drop 5%. I think 300 points down to 61.44. We're sitting right now at 64.49. 61.44 was the breakout level from that prior February top, before we had that quick cyclical bear market in March and April. So that's kind of where we're standing right now, and we're just kind of waiting. I think everyone's kind of waiting to see what the Fed has to say on Friday, and then we'll go from there. But right now, the market, most of our major indices near record highs. We've seen some lagging out of some areas, like the small caps and mid caps, but they've picked up a little bit recently. Last week actually was a very strong week for small caps. A lot of intraday buying, a lot of intraday rotation into small caps. So again, to me, that's a little bit of a picture being painted by the stock market, saying, interest rate cuts are on the way. And whether or not that's true, again, I think some of it will come down to what Fed Chief Powell has to say on Friday, and whether or not he sets up the Fed for a rate cut in September, or whether he takes the other side and says, still following the data, the inflation data, and wants to check that out. Again, I don't think the market would take that very kindly, based on the way that we've traded here over the last few weeks. All right, next, just pull up the S&P 500. We'll take a look at where we are. So here was the breakout. We did get up close to 6,500. So if you want to know the exact level of, intraday high was 64.8134. So we're literally 32 points away, half of 1% from setting a new all-time high on the S&P 500. So we're very close to all-time highs. We did pull back a little bit yesterday. Historically, yesterday is the worst day of the calendar month. It's the day that followed monthly option expiration Friday. So the Mondays that follow monthly option expiration Fridays, historically, those are the worst days of the calendar month. Just to give you a little bit of relativity there. The chance of any day being higher since 1950 is roughly 53% on the S&P 500. In other words, 53% of the days since 1950 have gone higher. 47% roughly have gone lower. The Monday that follows option expiration Friday, the S&P 500 has been up only 37% of those days, relative to the 53% I just talked about throughout the calendar year and for the last 75 years. So there's definitely been it's been more difficult for the market to move up after that, and there are reasons for it. When you go into option expiration week, if the market is going higher, which historically it has, then you typically will see the market maybe pull back a little bit during option expiration week. And then on Fridays, the monthly options, a lot of option holders will exercise those options. So instead of owning the options, they then own the underlying stock at the strike price. They buy it at the strike price. It doesn't avoid tax, but it delays tax consequences. So that's kind of a normal strategy. And the thing is, if a market maker is on the other side of an option, if that option holder decides to exercise and own the stock, the market maker is still on the other side of that trade and then is shorting the shares. So that's why there's still an impact that goes into the following week. But you can't argue with the facts. The historical facts are that from the 19th of a calendar month to the 25th of the calendar month, that's when the market typically does its worst. Now, keep in mind, while that to me signals, it's probably likely due to the options expiration and maybe the couple of days after options expire, you have to understand that date moves every month. So the third Friday of the month can fall anywhere from the 15th to the 21st. So so some months like this month, Friday was August 15th. And so that was the third Friday, and it's the earliest it can be. So sometimes you might see a little bit of weakness earlier than the 19th. So the last couple of days, we have kind of struggled a little bit. It's not like we've had a huge sell-off, but we have worked our way a little bit lower. And if it's due to options, it's happening a little bit earlier than what we normally would be looking for. But today is August the 19th. The 19th of the month is the worst. If you just look at days of the month, 1st through the 31st, since 1950, the last 75 years, the 19th is the worst day of the calendar month. So just giving you some historical data. You can do with it what you want. May not mean anything to you. I think if you're a long-term investor, it shouldn't mean anything to you. But if you're a trader, you do need to know that the tendency is for the market to struggle here a little bit. You should change your strategy somewhat and be a little bit less aggressive. I tend to take profits going into this period of the month just because I know the tendency is for the market to struggle a little bit. So it impacts my trading strategy in the short term, and I think that's pretty important. Let's see. What else do we have for you? I wanted to show you these ratios. So as we've come up off the low on the S&P 500 all the way back in April through August, you can see that the price action's been moving up for the last 4 months. The QQQ relative to the spider, that just gives us a little bit of growth versus value flavor. It's not that the S&P, I try to explain this. I'm not saying the S&P 500 is a value index. It's got both growth and value, but the QQQ is more heavily growth. So when you're looking at the QQQ versus the spider, you're looking at something that's much more growth oriented versus something that has less growth in it. So it would be by default a little more value oriented. And so I always like to see growth leading value during uptrends. For me, that tells me, it gives me an indication that rally is sustainable. Not that it's going to go up every day, but that if we do pull back, it's probably temporary, and that ultimately we're going to go back to the upside. So I don't worry as much about pullbacks when I know that the growth versus value ratios are supporting the prior move up in the S&P 500. And that's what I think this chart tells us. So the S&P 500 moving up, here's the QQQ versus a spider moving up. You look at the discretionary versus staples setting a new 6-7 month high right now. So money is rotating more towards the aggressive discretionary area instead of the more value oriented or defensive staples area of consumer spending. And I view this as one of the biggest ratios, intermarket ratios to follow, because our GDP is comprised of roughly 2/3 consumer spending. So where, which consumer stocks are going up versus the other makes a big difference in my mind in telling us whether or not the market rally is sustainable or not. And if you go back and you look at 2022, when the market was going up, setting its final high in January of 2022, right at the beginning of the year, discretionary staples had already started going down. And by the time the market broke down, the XLY XLP ratio, discretionary versus staples, was at like a 52-week low. I mean, it completely fallen apart, just as the S&P 500 was maybe losing its 50-day moving average, or might even been its 20-day moving average. Same thing happened back in February. We saw, look back here. This is let me get the date here. Right here is December, January, and February. So I'll leave that for you right there. Look at what happened in this discretionary versus staples ratio. We topped in the middle of January. The S&P topped in the middle of February. So as we were going up one more time on the S&P, look at what was happening to the ratio. We moved to about a 2.5-month low in this ratio at the time that we were setting that final high. So it's important to follow this ratio. And right now, the ratio is setting a new high. So I know there's a lot of people out there saying, well, what about the hot PPI that just came out? I mean, plus 0.9%. Hey, I agree. That was a crazy number. I wasn't expecting anything like that. I don't think anybody was. So, but I don't try to look at that and tell the market what it needs to do. I look at what happens to the money. Where's the money flowing? And after that report came out, we've got consumer discretionary versus staples moving to a new high. What's that tell us? It tells me that Wall Street's still moving money into discretionary stocks. Why would you do that if you're worried about inflation? That'd be the last place I would want to go, is consumer discretionary. We should be seeing this falling apart like we did in 2022 when we did have real inflation. We're getting, inflationary pops here and there. Little, they spook us a little bit, but inflation's been coming down for 3 years, the annual rate. And so again, the market is ignoring what we saw last week. That's what Wall Street is telling us. Inflation's not a problem. That's how I interpret all of this. Here you got Russell 1000 growth versus Russell 1000 value. So this is the large cap growth versus large cap value ETF. Since April, what are we doing? We're going higher. Here's another growth, large cap growth versus large cap value. This is the Dow Jones US Large Cap Growth Index versus the Dow Jones US Large Cap Value Index. Look at this, very similar to what I just showed you with the iShares. Growth going higher. Mid caps, growth versus value. We've seen a little bit of a pullback, but overall still in an uptrend. Same thing with the small caps. It's been a little bit rougher patch over the last 3 months, but we're still near a 52-week high. So it's not like growth stocks are being, everyone's exiting out of growth stocks because of inflationary pressures. And this is what I look at. I look at the charts. I don't care what the headlines are saying. I don't care anything about the media. I don't care about the gaps. I care about where we're finishing and how we're trading during the day. And what this tells me is that we're still fine. Does it tell me that we can't pull back 5%? No, that's normal. We've had a huge run off the April low. I can't tell you when or if we're going to have a 5% pullback. Maybe we don't have one this year or the rest of this year. Obviously, we had one earlier this year. But coming off that April low, pretty much since the middle part of April, we really haven't had a 5% pullback. And, maybe August and September is flat. Maybe we keep even, moving up. I think by the end of the year, we're still looking at a 7,000 S&P 500. I said that at the beginning of the year. I said it in the middle of the move to the downside. I even talked about the fact that I thought we were going to have at least a 10% correction earlier in 2025. So none of this has surprised me. I still believe we're ending the year at 7,000. I think one of the big things that needs to happen in order for us to get there is we have to see rate cuts. If we don't get a rate cut this year, we won't be at 7,000. I don't think that the Fed can kick the can down the road that far with the S&P 500 continuing to go higher. I just don't see that happening. So I do think at some point we're going to have the rate cuts. I believe it's the first one's coming in September, but I've been saying all along, I don't think they should have ever stopped. I think they should have continued quarter point cuts at every meeting this year. And based on the jobs reports that came out, I think that probably would have been a much better scenario for the market. It probably would have avoided this right here from February to early April had we continued cutting. So I think, and it's just my opinion, but I think the Fed was a very significant reason why we had that big drop. Anyway, so, I mean, you can see these ratios, though. They all look good. They all look like they're trending higher along with the S&P 500, and I think that's a good sign. Let's pull up, let's take a look at the NASDAQ 100. So very similar. We've come down for 3 days on the NASDAQ 100, but still comfortably above the 20-day moving average, which is comfortably above the 50-day moving average. I mean, this is the configuration that is a hallmark of a secular bull market advance. It's what you want to see, where you've got the shorter term 20-day moving average above the 50-day moving average and price action above both of them. Yes, we do still have somewhat of a negative divergence. Some of that is triggered by the fact that we had such a huge move up that the PPO makes an exaggerated push to the upside, so it gets very high. And then every time you set a new high, it's hard to get back up above that because the gains, you can't keep going up at that pace. So what the PPO is telling us is it's telling us that the pace of growth is slowing, which is a negative divergence. But you got to be careful after a huge move. It's similar to, and I always like to pull this one up just to give you a sense of kind of what I'm talking about here. Do you see back in, this is a monthly chart going back 50 years. And at the end of 1999 and into 2000, do you see how the pace of gains took off? Do you see what that does to the PPO? Now, in theory, by definition, every high that we have made since 2000 has a negative divergence on the monthly chart. Here's the PPO at this high. At every single high since we cleared 5,000, every single high, the PPO has been lower than where it was back in 2000. So by definition, we have a negative divergence, right? But if you took it literally and said, well, I'm not going to get in because momentum's slowing, you would have never gotten in at 5,000. I might have said this was, I don't know if I said S&P 500, but this is the NASDAQ. NASDAQ got to 5,000. I think it was 48 or 4,900 and something. Anyhow, we finally made that breakout, and every high since 2016, 2017, all the way up to 23,000 has come with a negative divergence. So are you going to not invest and miss the last 19,000, almost 20,000 points because we still have a negative divergence? And if you think that's silly, then my question is, okay, at what point, at what level of the PPO should we ignore? The PPO is not bound, so it can go as high as it wants. Obviously, it's somewhat restricted by the movement, the price movement. But when you look at this, when do we have a negative divergence? So if I go back now, we look at the NASDAQ and you see this, is this a negative divergence? When we first broke out above this high right here at 21.5, we've had a negative divergence now for over 2 months. And yet we've gone from this breakout level at 21.5 up to 24,000. That's another 12% higher. If you're strictly looking at this from a negative divergence perspective and saying, oh, momentum's slowing, I'm going to get out, you're still not back in yet. You still have a negative divergence. So there are limitations. My point here is every indicator has limitations. There are a lot of folks that will say, how can the market keep going up with these negative divergences? Well, the first thing I would say is that price volume is your number one indicator. It trumps everything else. And I would say PPOs and divergences are not even close. They're a distant second or third. And I would throw, I think divergences are important. I think they give us good clues, but I would throw relative strength up there as well. Now, not so much with an index, but with individual stocks. So if I'm looking at a stock and I see a negative divergence on a PPO, but I've got great relative strength, I'm not going to be as bearish about that stock. I mean, it's a stock that continues to show outperformance relative to its peers. Those are the kinds of companies I want to own. Now, in a perfect world, it'd be great to see that PPO go back to the center line, have enough of a pullback so that we can reset that PPO. But PPOs are not the primary indicator. You get a lot of folks that'll look at that and say, well, what about that? What about losing the 50-day moving average? Or what about falling below the 20-day moving average? Those are all secondary indicators. What about this ratio that you like to follow and the fact that it's turned down the last 3 days while the market's going up? Okay, it's worth watching, but it's a secondary indicator. The price action is not really giving us anything at this point to worry about, in my opinion. I think price continues to be strong. Could the negative divergence kick in? Might we see a 50-day test? Yeah, we could. Where's the S&P 500? Let's take a look at the S&P. So the 50-day right now is at 62.38. I just got done saying we could go to 61.44. Let me annotate this and show you what I'm talking about on the S&P. There was the high in February, right here. Broken resistance, that's resistance. Once you break resistance, that becomes support. So if we were to go down and lose the 50-day moving average, as far as I'm concerned, the more important level for me is 61.44, more so than the 50-day moving average. So we could lose the 50-day moving average and I'll still remain very bullish. And actually, if we were to get closer and closer to that 61.44, I would want to be more and more aggressive in the market. So that's just the way I look at it. Everybody has a different view. Feel free to disagree. But I have been following the market for a long time. I think there are certain things that are more important than others. And I do think price support, price resistance, and volume, those three combined, is the most important thing in the market. So as I look at this, I see 61.44 as a major support level in this market. Not the 20-day, not the 50-day, 61.44. And now if it goes below 61.44, does that mean we're in a bear market? No, but it's certainly going to open my eyes. I'm going to start looking at the market a little bit differently, looking to see, okay, did I miss something? What are all my other signals telling me? What's sentiment looking like? What period of the year are we getting ready to go into? I mean, if we were to go down to 61.44 and go just below it at the end of September or into early October, I wouldn't be worried about it as much because I know the best part of the year is coming up and many bottoms form during the month of October. So I'd be looking at it again as an opportunity, but I'd probably want to see some kind of reversal. Anyway, I'm going way out ahead of myself. We don't know what the market's going to look like over the next few months, next couple of months. I'm just throwing some things out there because I do like to think ahead just in case the market doesn't keep going higher or doesn't just simply go sideways. If it does start to pull back, you need to be thinking about, okay, which levels are the important levels? For me on the S&P, 61.44 is the big one. All right, let's take a look at the IWM. We're running out of time here. Just got another minute or so. IWM making a big breakout here just recently. Talked about that. It's pulled back, but I think it's holding this level pretty nicely. I think we're just consolidating here. I think the next move in the IWM is going to be the upside. And if the Fed does come through on Friday, if Fed Chief Powell does say something about, the jobs report where, we're starting to see it, we're starting to be more concerned about the economy. If he starts making subtle hints like that, even if he doesn't come out and say that we're going to be discussing a rate cut at the next meeting, if he just talks about the fact that they're growing more concerned about the economy, something along those lines, I think you're going to see the IWM explode back to the upside again. I don't care about the time of the month or whatever. I think that would be a really important development for the IWM. And I think technically we're set up on the IWM for higher prices. So that's certainly something that I would be thinking about and watching. One last thing before I go, I do want to just mention, this is it, folks, tonight, the quarterly draft top 10 stock picks. If you want to be there for the portfolio reveal, if you want to know the stocks that are going to go into the portfolio to try to beat the S&P 500 for the next 3 months, you need to be a member of Earnings Beats, a trial member. You don't even have to be a paid member. Come in for 30 days and try us for free. You will need to provide us a credit card. Can't get you set up in our system without a credit card, but come in and check us out, experience us for the next 30 days, and then make a decision. But in the meantime, you will get many of the stocks that I'm going to be trading over the next 3 months. So hope to see you there. Certainly appreciate everybody having patience this weekend, all the members at Earnings Beats. Thank you so much. This was one of those out-of-town golf trips for me this past weekend. Just had no time to really work on anything. It's very difficult. Did get all the chart list updated at the end of last week, though. So those should be good to go. Or hopefully you've downloaded those. They should have been good to go yesterday morning. And we'll get everything else caught up by the end of this week and back on our regular schedule. So have a great rest of your day. And I will see many of you later today at 5:30. I am heading into our, what I like to call my war room, to start getting ready to pick the stocks that I like for the next 90 days. Have a great rest of your day, everybody. Happy trading.